So basically, what could she do? The truth is, it depends. Each bank and credit union may have different guidelines on how to handle this particular situation. Different account types have different defined roles for each person in each account. Do you know what guidelines your financial institution has with this particular instance? The goal of tonight's class is not really about John and Lily or their circumstance, but it is really about you opening a dialogue and understanding what your role is, what the role is at your financial institution, what are your rights, what guidelines. If you were in this circumstance, what could you do? Would you be able to easily access that money? Do you know what documents that you can put in place to help prevent a situation like this? Because in all those questions that we have, the debit card, could you use online banking? Lily is not authorized because in this particular instance, it is strictly an individual account. So tonight, our guest speaker will provide information for you and some legal tools available that can help you on your quest to make sure you protect your money and protect your wishes. El Verdure practice focuses on personal injury, estate planning, and civil immigration in the state and federal court. El protects the personal rights of injured persons, families, sponsors, and beneficiaries in our community. Prior to her current practice, El clerked for the presiding Honorable Chief Judge Brian A. Jackson of the U.S. District Court of Appeals in Louisiana and the Louisiana State Senate. While in law school, she was a student attorney for the Elder and the Successions Clinic at Southern University Law Center. Today, Elle understands how important your family is, and she is here to provide information for you to begin your protection plan during COVID and beyond. So please help me welcome Ms. Elle Verdure.
Thank you, Kim and Neighbors Federal Credit Union, for having me and inviting me to join this conversation this evening. It's truly an honor to share this platform with you and to really get the listeners and some of the members involved in protecting themselves and their family and their property. Before I jump right in, I want our listeners to promise me something. Grab a pen, a paper, or envelope, receipt, whatever you can do to write something down, and write every single question that comes to your mind while we are having this discussion. Anything that sticks out to you, go ahead and jot it down. Then sometime this week, take that list of questions and invite your family and your financial institution to help you answer those questions. Now let's jump right in because we don't have much time left. When we talk about money, what comes to your mind? Maybe you say, I need more of it, I need to learn how to manage it, and if you said those things, you are in good company. But I believe what we're really talking about is experiences. You only need money to access those experiences that you want in life and that you want for your family. Generally, with those experiences, you think about who you want to share those things with, who you want to have a crawfish boil with, who you want to take out on the boat. You want to be able to treat those around you and have these experiences to create memories. So, and not just family, but it's also friends, because I consider friends my family as well. But for tonight's sake, we will talk specifically about family and those relationships with money, with your financial institution, and with knowing your rights. So the first thing I want to ask is, what is your role in your family? If you said that I am the baby of the family, I am the middle child of the family, I'm the giver of the family, I'm the taker of the family, if you said any of those things, keep those thoughts. But for now, I'm specifically asking, are you the spender of the family? Are you the giver or the saver of the family? Are you the investor or planner? And, you know, whatever your response is, go with that. Accept your natural and required role in your family, but try to build on that. It's important to identify and acknowledge your task in the family when it comes to your financial and other duties. And myself, I am a saver. So let's look back at that scenario that Kim read before. It talks about John and Lily each have their own individual bank accounts, and they have a joint bank account that they use to pay those household expenses, and each of their direct deposits go into their individual bank accounts, and they manually move that money to the joint account each pay period. Now there's so many things that I have highlighted with just that paragraph, because there's quite a few things that can go wrong and did go wrong later in that scenario. The first thing is there's a lot of weaknesses in their plan. So one of the things that we talk about in wellness classes and staying healthy, financially healthy, is routines. And someone once said, your strengths will always be your strengths. And your blessings will always be attached to your journey and your path, and not the path that you're trying to force. So if you're a spender, stop trying to force yourself to be a saver. Try to force yourself to figure out how to be a better spender, how to make your money work for you. Because I'm a saver, I'm always looking for the best ways to save. But I acknowledge that putting my savings in a savings account where I'm gaining 10 cents a month is not always the best way to save, right? It means that I have money, but my money is not working for me. And as a saver, I acknowledge all the spenders in my life, and I know you're watching now, and all the investors in my life. And I find secret ways to create them to be the best secret savers that they can be, by presenting new programs with their financial institutions that allow them to keep their coveted roles. Some of these ways could be accumulating points, cash back, higher interest rates that brings back those benefits to the family. Let's see, and there's some other ways, but you can talk to your financial institution. Let's see, okay, so let's get back into that scenario. So some routines to address when you talk about John and Lily's role is that we already can establish that because they have individual bank accounts, with those individual bank accounts, it's assumed that this is a two-income household, right? And it doesn't appear, or we don't have many facts to establish that they have any other assets. Both are contributors to the household and sustain basic needs. They sustain basic needs with those direct deposits, but there's no other information is given for those roles. The next, we want to address a major issue about how they address their expenses, how they pay their household expenses. One of the things that they are doing is that they are paying automatic withdrawals or automatic drafts for their expenses, but with that, they are not having any income go into that same account. So that's a major problem. If you have any type of bills being automatically drafted out of your account, you need at least one direct deposit going into that account. Otherwise, as we see in the scenario, there are many problems that can develop. These residual automatic deposits are much better than a manual deposit. And then let's get into those deposits. So there's different options for your deposits. Option one is have at least one direct deposit that we talked about, one direct deposit that's able to cover the entire month of bills that you are having automatically withdrawn from your account. Option two is pay all those monthly bills by automatic draft from maybe a credit card. That way you can earn points, you can earn cash back, you can earn all kinds of benefits while you're spending for your monthly bills. And then you, let's not forget that you pay off your credit card balance in full every month if you're having these withdrawn each month, because it doesn't mean that you can put off paying your monthly bills. That's just a wise credit option. There are many more options that you can talk to with your financial institution. Let's see, manually moving the money. Okay, there are some issues that we have with this. Now, manually moving your money is intended for a periodic, unexpected circumstance. There are a few questions we should ask ourselves. Do you know what your financial institution's transfer limit per month? Do you know what your financial institution's withdrawal limit is per month? And how many of those withdrawals you can have? Do you know your institution's options for automatic money transfers? Because this seems to be a better option for Lily and John. If hindsight was 2020, this is a better option for them, is to have an automatic withdrawal from their individual accounts into their joint account. Now, when we talk about the multiple manual transfers, one of the major issues that I'm sure that you're thinking about is they will probably reach their limit. So if they're transferring money multiple times a month, this will cause them to reach their limit. Once you reach your limit, no matter how many drafts you have established online, it will not go past that limit. And because they didn't have any going into there because of John's brush with the terrible circumstance of that automobile accident, they incurred overdraft fees, but other ways that this can affect your relationship with the financial institution is future grace and overrides. So your financial institution is there to be of assistance to you. So if you do come upon hard times, like Lily and John, you can ask them if they can maybe have some sort of plan where some of the fees can be waived because of this isolated incident. However, if you consistently overdraft your account, that grace is not going to be there for you. In addition, future lending from that institution evaluates how you bank with them and how you lend and how you interact with their institution. So the next thing we want to talk about is setting intentions. So what John and Lily, we're going to talk about what they should have done. Have you established some long-term and short-term goals? It's unclear with the scenario, but maybe John and Lily should have come up with some short-term and long-term goals. It appears that they only had the short-term goal because they were transferring money each month routinely as a way of life, but they could have made their life a lot easier, saved time, if they would have had a short-term goal of, okay, let's just direct deposit and consistently from one of our accounts, and they wouldn't have had this problem. Also, let's see, so when we talk about small and large goals, one of my examples for the short-term goal might be a vacation, a family activity, a concert, getting signed up with the 401k. But also, well, the 401k is more of the long-term goal, but also maybe when you want to retire. What is that money goal that you want? And making your money work for you is a good way to achieve those goals. So the next thing we want to talk about is get right into, we've been talking about money, but let's get a little more specific. And let's talk about the specific accounts and some questions you should ask your financial institution. So do you know whether you have an individual account or a joint account. Knowing these things, you know them when you first sign up, but do you actively acknowledge what those benefits are? And knowing those things are very important. Do you know if you're a primary holder or if you're a joint account holder? With these differences, there are things that you can do with your account and things that you can't do with your account. And we have Kim that can explain maybe really quick some benefits and some characteristics of primary account holder and joint account holder.
Again, the information that you're getting tonight, you want to definitely verify what your financial institution's guidelines are going to be. But in general, if you are a primary account holder, you generally can negotiate transactions on your account without having authorization from any of the other parties. But again, be clear that this can vary from institution to institution. Typically, a joint holder or an authorized user may have restrictions. And so the point of our webinar tonight is really to have you ask those particular questions, to be able to understand before you get in a situation like John and Lily and realize that, oh my goodness, I thought I had access to the account. I'm a joint, I'm an authorized user. I thought I'd be able to easily get access to this money. We don't want you to make assumptions and then find out that you're in a situation where you will not have access. So find out from your financial institution what your role is, what you can and cannot do. But typically the primary can usually do those transactions solo or alone or without authorizations of the other individuals. Usually your joint or your authorized user will need to get some type of authorization from the primary.
Thank you, Kim. So let's talk about some important money lessons. The first is delayed gratification. You may have to wait for some things for future gains. The next, spend money. You need to make choices about how to spend money. What is the most efficient and beneficiary way to spend your money? You may have to consult a financial advisor. Your financial institution can provide you with tools on how to get started. The next is save money, and the location of where you save that money counts. The sooner you save, the faster your money will grow. And what I had to learn, because saving every penny, like we talked about before, is a good thing, but if you're saving it in the wrong location, then you need to reevaluate. Financial purpose, establish a short-term and long-term goals. I can't stress that enough. The short-term goals will keep you married to your financial institution, and the long-term goals will help you be committed or help you see the bigger picture, right? Of when the ultimate goal is when you can retire. Everyone wants to retire, the sooner the better, right? Proper use of credit. Now this, I can't stress that enough, because although you can have all the money in the world, at some point you're going to need good credit. And right now, if you're like many of us, we don't have all the money in the world, which is why maybe you're looking at this webinar. So I'll have, maybe once we get back to it, if Kim has any lessons on money or anything you want to add to that list.
I think for any goals that you have, one thing that you always want to have is a budget. A budget, whether you're a spender or a saver, whether you want to invest, it will actually help you understand where you are, what your strengths are, and then what your deficiencies are, and then you can build upon that. So like she said, if you're a saver and you've acknowledged that you're a saver, but you want to be the best saver you can be, look at your budget and see where those deficiencies, what can you change in your budget so that you can be a better saver. If you're spending all the time, and you may not even realize that you're a spender until you create a budget, you can look at, again, what are some areas that you can change, or how can you redefine your spending practices so that you can achieve those financial goals.
That is definitely right. So now let's get into your rights. Why, a big question is, most people say, I'm too young, why do I need to have an action plan, right? I just work hard and everything will come to me. Well, if you fail to plan, you plan to fail. And I know you've heard that a time or two, so I'll say it again. First thing you want to do is to protect all of your hard work. So that's why you plan, is because you don't want to work hard and have someone take it or, flail it away on frivolous things. You want to keep down the confusion and family feuds between family members. That's why you have an action plan. You want to make your intentions known to family members regarding your assets, health, and maybe the funeral plans, what we'll get ready to get into. If your family is like mine, they have very strong opinions and will take over whatever decision needs to be made. They'll take over the room if you give them room. So we'll give you some legal tools that can be different. But there are two types there, and there's probably more, but the basic types are general versus health, right? So the general power of attorney is a mandate. It authorizes somebody who you trust on your behalf regarding your affairs. The duties include management or decision making in the following areas: financial, business, personal, legal. It gives that agent or that attorney, in fact, the ability to manage one's affairs when one is capable of managing affairs. When one is incapable, of managing affairs. The requirements of a POA or a power of attorney: it requires the notary, it requires the principal, which is you, and it requires the holder of the power of attorney, so the person you are giving that right to. And after finalization of the power of attorney, it is definitely advisable to file that document in the mortgage and conveyance records with your financial institution, maybe with your primary care physician. And in the event of any type of incapacity, death, or unavailability, a power of attorney can authorize account holder's agent to access and manage your account needs. And the next is the healthcare power of attorney. This is one that most people do not talk about, but it's something that definitely needs to be talked about. This is similar to a general power of attorney, but it's kind of exclusive in that it deals with medical decisions. And you never know you're going to need a medical decision made for you until maybe you're like John and you get in an accident. But can you plan for that? Sure you can. You can plan for that now and today, starting today, by figuring out who the strengths, we'll go back to the strengths and the weaknesses of your trusted advisors, the people that are around you. There is always someone that, one of your friends, you're like, you know what, they're really good with money, so I may have them as my general power of attorney. But you have others who are more thoughtful and, are tapped into your specific personal needs. And they may be someone who is good for your health power of attorney. I always suggest these are not emotional decisions, right? Because when your life is on the line, you don't want some wildcat out there making these decisions, trying to, I say this lightly, but trying to kill you because they want you out of the way, right? You want someone who you trust, and you love. I say look in your inner circle. If this is someone you talk to maybe every day, or this could be somebody who you don't talk to as often, but you wish you could talk to them often, but life happens. But it's definitely a trusted person within your circle. Now, a portion of this healthcare power of attorney allows you to state your intentions, to say whether you want to be resuscitated, to say whether you want to receive nourishment, or whether you want to be on life support. These are things and areas that you need to think about, because if you don't think about them now, you'll leave it up to whoever's in charge or whoever has the loudest voice later. Now let's go and get into some areas that have you thinking about protecting more than just your bank account or more than just your health, but maybe a broader picture. So going along with that health, we're going with the living will. This is another legal tool. So the legal living will it's a document that provides direction and guidance to family members and physicians of your intent to preserve your life using life-sustaining measures. But usually when it's a general will, this is something that is frequently used for those who have terminal illnesses or irreversible injury, right? So most of the time when you're doing a living will, you already know that something is going on health-wise and you want to start getting your affairs in order. Let's see, some other ways that you have or means that you have living wills is terminal illness, any type of disease or illness or continual profound comatose state. Usually this will help you, but if you're in a comatose state, you can't create your living will. So this would already need to be done. Now let's switch over to last will and testament. Now this will allows you to dispose of your property, and that's immovable property, movable property, and anything of the like. It could be a diamond ring, or it can be anything that you cherish that you want to specifically control where it goes after your death. And it's extremely important that you make your intentions known for which specific property you want to be included in the will, but also where it is to go. There are some things that are prohibited by law, but that's for another seminar. There are two types of will. So you don't always have to go and get something typed up. You can handwrite, and I usually suggest starting off with a holographic will. So this is a handwritten, dated, signed will in the testator or the creator yourself in your handwriting. There are some problems with the handwritten will, but this is a good starting point. I usually say if you can write it out and you can bring it to an attorney to bring that forth and work out some of the kinks in what your desires are. The next one is a notorial will. Now, just like its name, it's a document, a self-proving document that is executed before a notary public and two competent independent witnesses. These witnesses, especially in Louisiana law, should not be beneficiaries, because usually you're bequeathing something or transferring something to these people, and if they are your witnesses, it's likely that that transfer and your intentions will not be transferred to them because they were a witness. So I always say an independent, competent witness, just somebody, maybe that the attorney knows, or somebody in the office who is not a part of your will, who will not benefit from your will. With these notorial wills, each page must be signed, and usually they're typewritten, and they must be executed. Now, one thing about notorial will, some of them may not have this, but this is definitely an area that you have to ensure that once the signatures and once it's executed by the witnesses, that the testator, the creator, yourself, after you have declared to the notary and the witnesses that you have read the will in its entirety, and that your will is the last will and testament up until that point. And if you do not claim that, or if there is no document or clause in there, then that will may be disputed. And let's see. So the final one that we'll talk about, and not the final one, but we have a couple more, but is the trust. Most people love to talk about the trust, and The reason why I like to talk about the trust, because there's a lot of control that you can have within this trust, and a lot of laws that protect trust as well, if they're done right. So an individual will use a trust when he or she wants a third party to manage property, immovable or movable property, either for themselves or for another person. Pursuant to the terms of the trust, yourself, the creator, gives direction on how the property will be managed, the terms of the distribution or the transfer of any of the property, and the period of time for which the trust will stay in existence. There are some great tax benefits for inter vivos or living trust, but that's, like I said, for another seminar. And then there's Testamentary Trust, which is created within the will or in addition to the will to be activated at the death of the testator or the creator yourself. And let's see. Now, the trust can be revocable or irrevocable, and with the revocation, the trust returns to the settlor or the creator. Now, what must be addressed is that all trusts are considered to be irrevocable unless the creator yourself specifically and expressly states and reserves that right to revoke or to modify. Now, the last two tools are specific. They're specific to protect your interests. They're very similar. They are made two different ways. So we'll talk about the life insurance policy. Now, this is contractual in nature. The life insurance policy, there are plenty, like almost anybody you can think of has created a life insurance policy within the financial world. The terms of the life insurance policy governs the activation and distribution. Only the designated beneficiary is the sole beneficiary. It does not go to your estate unless you do not put a beneficiary on there. And those can be whole or term life. And then the final one is payable at or payable on death account. Now, these are similar in a lot of ways to life insurance policies. Payable on death, or some say transfer on death, is an account at a financial institution that allows payment of the funds in the account to a designated person upon death of the account holder. The important fact is that the funds are only what the depositor, only what you as the account holder have contributed, plus any interest or dividends, which is different from the life insurance policy because you're paying for a lump sum policy, but you may not have put $500,000 in premiums toward that life insurance policy. But with the payment on death account, it's only what you've deposited. And just like, excuse me, just like the life insurance policy, you have to be a designated beneficiary express, or else it will go to the estate. And let's see, now let's get to the fun part. And this is a little document that I created to help you start and begin your process in organizing your estate. Now let me see if I can get it up so that you all can see. Okay, can you all see that? Okay, let's see if we can make it bigger. Okay, so this is a little document that we have, that I've created to help you begin the process and encourages you to build even more assets that overshadow your liabilities. So when you're going, when you take your questions and you go through all of your assets and all of your liabilities, it's important to put this on this paper. You can print it out, and if you have this is the document that we use upon someone's death and we're doing their succession. This is the document that we can establish and start moving your succession through. But I say it's a motivation tool because I want more assets than liability. I want to pass down generational wealth to all of my loved ones, all the ones who I'm thinking about, and I don't want them to have to pay all my bills and get $1,000 each. No, I want to have some sort of legacy so that they don't have to start from the bottom floor. They can start a little bit higher, and then they can propel themselves and hopefully do the same thing. So with that said, if you have any questions about that, let us know, but I think we have a few more questions, Kim, that we can address.
Okay. So again, thank everyone for tuning in tonight. This will be the opportunity. If you do have some questions, please go ahead and send those to us through Facebook. We will attempt to answer whatever questions you send tonight. However, if you have questions after tonight's session concludes, we do have our email address information for both myself and Elle. You can definitely contact us through email and we'll be happy to answer. We do have one question from Keandra, and her question is, in the event of a death, can your spouse automatically access your bank account if they are not listed on it? In a nutshell, the answer to that question is no. I can tell you for any financial institution, one of the first steps or one of the first pieces of the process will be they need verification that that person is deceased. Beyond that, it will be determined by what steps or measures did that person put in place to give you access to that account. Just as Elle spoke a minute ago, PLD is a great document, payable on death. Perhaps your spouse put that document in place saying that in the event of his death, that you would have access to account number at 1, 2, 3, 4. And if it is listed as that, once you've provided that financial institution, typically with proof of death, then usually that document would allow you to have access. So there's not going to be a circumstance where you can just walk in and say, hey, my spouse has passed, I'm the spouse, I need to have access to the money. And that's the purpose, of course, of this workshop, so that you will know what steps do you need to take. Often death comes unexpected. We like to think that we're going to live to be 99, and even if you think it's not going to be that long, we always think we have until tomorrow to get these documents in order. But Corona has unfortunately, shown us that so many people, young and old, unexpectedly have lost their life and their finances were not in order. And that's one of the reasons we thought this was extremely timely to bring this particular content to you, so that you can go ahead and have those discussions with your loved ones, have those discussions with your financial institutions, see what documents you need to have in place so that if something happens, do you want your children to be able to have access to your money? Maybe you don't want them to have access while you're living, but perhaps after you've passed on. But it could be a two-way street. Maybe you do want them to have access. If you can't take care of your money, you're laid up in a hospital and they can't pay your light bill, they can't pay your mortgage note because you're the only person that has access to those documents. These are things to think about. So we'll pause and see if we have any other questions.
And the last thing about that, can you take away the money from the account? There are some legal consequences for taking money out of account before the financial institution is notified of that death. And you may be opening yourself up to liability to the estate of the deceased if you take money out of an account prior to the bank knowing about it, because they can call that amount back to the estate. So just consider that should you ever run into that issue.
Okay, we have another question. The question says, let's see, hang on one second. Can you have a payable on death account at your financial institution for savings and checking account? I know at Neighbors you can. Basically, the POD, you designate the specific accounts that you have at that institution that you want covered. Maybe you have a savings, maybe you have a checking, maybe you have a CD. You would specify which particular accounts you want listed on that payable death and who the beneficiary is. You may want certain accounts to go to one person and certain to go to other. But again, we encourage you to reach out to your financial institution to see what their guidelines are. All right, let me check and see if we have one more. Again, we hope that this information just starts that dialogue for you while we're checking for additional questions. Check with your financial institution. We realize that many of you obviously may bank at Neighbors. We may be your primary institution, but we also realize, like in John and Lily's case, that sometimes you have multiple accounts, and what the guidelines are for one financial institution may vary from the other. Unfortunately, we get those circumstances all the time. Somebody walks in the door and says, hey, I'd like to use this power of attorney, I'd like to use this document to do something, and we may have a different rule, and they'll say, well, hey, this financial institution or this bank allowed us to do it this way, and that's just not our particular rules. And then it says, do you encourage families to get life insurance on their children? If so, what's the best type of insurance to look into for young children? And I'll let Elle address that particular question.
Absolutely. Okay. Life insurance it's different. It's not exactly put into the estate unless you don't have a designated beneficiary. No matter how many people you have attached to your family, the children, they definitely need life insurance plans. Theirs may not need to be as big depending on how old they are, but definitely having life insurance. And I like the term life, but there's many people that like whole life, so each life insurance policy is different. It's contractual. Just because it says it's term doesn't mean that it's necessarily term. Just because it's whole doesn't mean that it's necessarily home. So you have to read that. Contract. And the best thing is to get that financial advisor. Speak with the insurance agents. They call me all the time, asking me about life insurance policy plans, and to have more than just one. You don't have to get all your life insurance from one institution. You can spread it out. Check with your financial institution. They have plenty of life insurance policies that they can provide for you and for you to choose from. But definitely want to get one, I say, on each person in your family, even if it's $10,000, a funeral. And I don't want to say and wish death upon anybody, but death is inevitable. Just like change is inevitable, death is inevitable. And $10,000 can at least cover the funeral expenses, right? So just at minimum, you want to get that. I would suggest. So.
Okay, we have another question. It says, does a payable on death include IRAs? When you open an IRA, which is an individual retirement account, that particular type of account will have its own designated beneficiary. It should be, if not at your financial institution, a requirement. When you open up this particular account, you will be required or requested, strongly urged, to list a beneficiary. And so that would be separate from your POD. Your payable death would refer to all of your other accounts within the institution, your checking, your savings, your CD. But your IRA, you will be specifically asked to have a beneficiary when that account is established. Whereas with your checking and savings, if you don't put any documents into place, then that is not a requirement of the financial institution. All right, we want to again thank our guests for joining us tonight. Again, our email addresses are listed up there. If you do have any additional questions for us, please feel free to reach out. I want to thank Elle for joining us. That was a lot of very good information. Again, we hope going forward you will have discussions with your families. You will reach out to your financial institutions, take a look at what your role is, maybe even pause some scenarios, talk to your family. What would happen if I wake up tomorrow and don't make it back home? What would happen to the account? Do we have joint accounts? What does that mean? If I'm the primary, can my spouse act on my behalf? Can he just walk in and get money? As somebody said, can they automatically get it in the event of the death? Typically, things don't automatically happen that way. We will follow up this session, hopefully with more discussion depending on the questions that we have. But again, we want to thank you for joining us, and we look forward to seeing you again soon.